Chapter 5, Learning Objectives for Cost, Volume, Profit. Distinguish, first of all, between a variable cost and a fixed cost. And when we talk about fixed costs, we have to bring in the idea of relevant range. Now, some costs are partly fixed and partly variable, so they're called mixed costs. And we're going to explain the concept of mixed costs. Then we're going to look at cost, volume, profit. And then we're going to introduce a new term called the contribution margin. It's a new way of formatting the accounting data. And then we'll look at how we can use that to determine the break-even point, and not only that, the amount of sales required to earn a target net income. And lastly, a concept of margin of safety. So you'd be responsible for all of these terminologies and explanations. Cost behavior analysis. The idea here is that costs change when business activities change, but some costs change in direct proportion to changes, others do not, and some remain the same. And understanding the difference between them helps us to plan operations and decide between different courses of action. Okay? Now, when we talk about behavior analysis, we talk about how it changes, how costs respond to changes in the level of business activity. Now, when we talk about activity, we have to be clear. Are we talking sales? Are we talking miles driven, room occupancy? Whatever the activity, we're going to look at if the activity doubles, does the cost double? Does it change in direct proportion, or does it not? In the study of how specific costs respond to changes, we look at the level or the volume of activity. And the activity level is called the volume index, and we measure costs related to that. Now, the costs again are in three categories: variable, fixed, and mixed. A variable cost. A variable cost is a cost, now remember this, that changes in total, in direct proportion with changes in the level of activity. That is, if the activity increases 10%, then the variable cost will increase 10%. If it decreases 25%, then the variable cost in total will decrease 25%. The thing is, a variable cost remains the same when I'm talking per unit basis. We define it as variable if it changes in total, but it remains the same if we're talking about a unit. For example, we have a company that manufactures a $10 camera. The activity level is the number of tablets produced that has this $10 camera. They manufacture each tablet, the total cost of the camera increases by 10%. As part of the illustration A, so at 0, I have 0 costs. If it increased by $10 at 2 units, my total cost is 20. At 4 units, my total cost is 40. At 6 units, my total cost is 60. So you see, this line is linear, and I can predict what the variable cost would be at any level of production. So you give me 15 tablets, I could tell you that the total cost for cameras would be 150. However, we look on a per unit basis. Okay, we're just looking at one unit. The cost per camera per unit remains 10. If I produce 20 units, the cost per unit is 10. If I produce 8 units, the cost per unit is 10. Now, if we graph it, that's how it would look like. Now, compared to a fixed cost remains the same in total, regardless of the level of activity. However, on a per unit base, it varies inversely. Examples: property taxes, they don't change with any activity. Insurance doesn't change with any activity. In total, the rent doesn't change with any activity. So you see, when I graph it, it doesn't matter how many units I produce if I'm talking about unit computers produced. The fixed cost will always be the same in total. However, the fixed cost will go down as I per unit. The more units I produce, the fixed cost per unit will go down. So at 2,000, the cost per tablet now is $5. At one tablet, the cost for rent, let's say, was 10,000. Well, as I produce more computers, the cost of rent per computer will go down. And fixed costs can be graphed in that way. Now, the idea of relevant range. Fixed costs will perform that way within a certain level of activity. But once we go outside that activity, for example, we produce much more than we can do in this building, we have to add more fixed costs. So you see, the fixed cost has to be added in chunks. Once I get to a certain level of activity here, I need to add more capacity. And once I get to this level of activity, I have to add more capacity. So that's the idea of relevant range. But for all the problems we're going to do, we're always going to be within the relevant range. So we don't have to worry about it. You just understand that concept. Now, there are some costs that are mixed. That is, they are partly fixed, like this, and then they increase in a linear fashion. That is, they don't remain the same in total. The total is changing, but it's not changing in proportion to changes in the level of activity. For example, you take a look. Here at 10,000 units, these are the costs for direct material, maintenance, direct labor, and so on. At double the production, 20,000 units, these are the costs. Well, look at direct labor or direct materials, doubled. So that is variable. Maintenance increased, so it's not fixed, but it didn't double. So it's a mixed cost. Direct labor doubled. So that's a variable cost. It changes in direct proportion to changes in the level of activity. Same with indirect materials. Depreciation was 4,000 at 10,000 units, and it's 4,000 at 20. So you see, it's a fixed cost. And so is rent a fixed cost. But utilities increased, but it did not double. So you see, when you look at it this way, then you can distinguish the variable costs, a direct material, direct labor, indirect materials. Fixed cost is depreciation, rent. Utilities is maintenance, or mixed is maintenance and utilities. So there's your three cost elements, okay? Now, we can't deal with the mixed cost. What we have to do is break it out into its fixed and its variable portion. And the way we do that is called the high-low method. That is, mixed costs must be classified either in their fixed and variable. High-low uses the total cost incurred to classify the mixed costs. The difference between the high and the low represents the variable costs because they are the only ones that change with activity level. Now, this is best done with a demonstration. The formula is the change in costs divided by the high activity level minus the low activity level equals the variable cost per unit. So therefore, in an example, Metro Transit Company has the following maintenance costs and mileage for its buses. In January, 20,000, February 40, March 35, April 50. So you see, the lowest activity is January and the highest is April. The cost, you see, in January it was 30,000 for 20,000 miles. It's 48,000 for 40. You see, we doubled the activity, doubled the number of miles, but the cost did not double. So we know that this is a mixed cost. What we do is we take the change in costs, which is change in 30,063, over the change in activity, 20,000 and the 50,000. And so we say, okay, the costs changed 33,000 when we did 30,000 more miles. So obviously, the cost is $1.10 per mile. That's the variable portion. Now, to figure out the fixed portion, we say, okay, look. At the high level, we know the total costs were 63,000. Well, if the total costs are 63,000 and the number of miles that we drove was 50,000, then the variable cost would have been 50,000 times 110, which is 55,000. So 55,000 of that 63 is the variable cost. Therefore, the fixed has to be 8. We check that. We do it at the low level. At the low level, the total cost was 30,000. Now, that total cost is partly fixed and partly variable. Well, we know that the variable portion is 20 because the cost was 30,000 at 20,000 miles. The variable portion then would be 20,000 times $1.10, and the fixed portion would be 8. So we know that the formula for this is a variable cost of $1.10 per mile and a fixed cost of 8,000. So it's actually y equals a plus bx. So at 45,000 miles, all I know the fixed is going to be 8,000, Mafi Muskila, but the variable is going to be 110 times 45,000 miles, or 49, and that way I'm able to predict what my total cost would be. So I can use this model to predict what my total cost would be in the future at any level of activity for maintenance costs. And I also have the breakout of the total cost into its fixed and its variable portion. Okay. Now that I have everything in fixed and variable, I can go forward with what's called the cost volume profit model. This is very important for product and profit planning, setting selling prices, determine product mix, maximizing production facilities. The idea here, the basic components, it's the level of activity. Let's say sales. We always use sales as an example. Now, we deal on a unit basis. We have the unit selling price for every unit I sell. What's my selling price? I have the variable cost per unit and the total costs. Okay, and then later on we'll talk about the sales mix. But these are the 4 components we need to look at right now. Assumptions. We're assuming that these costs are linear. We're also assuming that we can break them into fixed and variable portions, and so on. So we can also reformat the income statement. Our income statement generally is revenue minus expenses. But now that we know the expenses are either fixed or variable, we can, for internal use, separate them. For example, an income statement. Varg Video produces a high definition. Okay, relevant data is the unit selling price is 500, variable cost is 3, total fixed cost is 200, and I sold 1,600 units. So now that I have the units and the selling price, I can do an income statement. Okay, I sold 1,600 camcorders at, what was it, 500 each, so that sell 800. But I subtract from the selling price, total sales, the variable cost, the total variable cost. Variable costs were 1,600 times camcorders times $300 for 480. And I get then the contribution margin. That is what's left over after I cover my variable costs. That's not profit because I have the fixed costs that I have to cover. And what's left then is net income. Okay, so this way, you see, this introduces the idea of a contribution margin, which is a new term. Contribution margin is simply the selling price minus per unit minus the variable cost per unit gives you the contribution margin per unit. And this is what I use now to do my analysis. I format selling price minus variable cost. These are 2 variables. But when I subtract them, I'm dealing with 1 variable now, which is called the contribution margin. And then the contribution margin per unit, I can figure out how many units do I have to sell. I make a contribution margin of $200 per unit. How many units do I have to sell to cover my fixed costs of 200,000? Well, the answer is 1,000 units. And that gives me what I call break even. Break even is that level of activity where I do not earn a profit or incur a loss. That is 0 net income. Assume now that Vargo sold 1 more camcorder. They sold 1,001. Well, their total sales then would be this, their variable costs would be this, their contribution margin in total would be this. Okay, but you can see now that I have a contribution margin 200 more than my fixed cost, my profit is 200. So for every unit I sell above my break even of 1,000 camcorders, I can predict my profit. If I sold 10 units more than 1,000 that I need to break even, then I make 2,000 in profit. If I sold 1,000 more, then I make 200,000 more in profit. I can predict my profit at any level. Another concept, the same idea, but we put it into a ratio. A ratio is simply a percentage. So we take the contribution margin per unit, which is 200, and we divide it by the selling price, and that says our contribution margin is 40%. What that means is if we sell for a dollar, the variable costs are 60 cents. The contribution margin would be 40 cents. So the contribution margin ratio would be 40%. We always put the selling price as 100, variable cost as a percentage of selling price, and contribution margin ratio. Now I can use the ratio to predict when I use but the ratio now gives me in sales dollars. It helps me determine what the sales dollars are, and we'll do problems on that. Another example of contribution margin ratio. Now we get to the break even. We already covered a bit of that break even, but there are different ways of doing it. We just talked about the contribution margin, and that's the way we want to use it. But again, to go over, break even is when total revenue is equal total costs, both fixed and variable costs. The mathematical equation may make sense to you. We're going to let Q be the quantity, or X, if you will, 500X minus 300X, or Q. So equals 200,000, and to break even, I want a net income of 0. So on this side of the equal sign, I format that. I have 200Q equals 200,000. Q equals 1,000. Okay. So you can see that 200Q is actually a contribution margin. Now the contribution margin technique, you simply come up with a contribution margin and divide it, which is 200, and divide it into fixed cost, and that gives you 1,000 units to break even. So that's very useful in determining what level of activity I need to break even. If I do it in ratio, I get the level of activity in dollars, the same thing. Here's an example, okay? We have a unit selling price of 400, variable cost of 240, fixed cost of 180. Calculate the break-even point mathematically and contribution. All right, sales, 400X or Q, variable cost, 240Q, fixed costs 180, net income 0, and therefore I get it this way. Q equals 1,125 units. That's mathematical. Contribution, I say, look, the selling price is 400, the variable cost is 240, so the contribution margin is the difference between that, which is 160. And all I do is divide 160 into the fixed costs, and I get 1,125 units. So you see how valuable this idea of contribution margin. It's just this difference between the selling price and the variable cost per unit. Not only do I want to have 0 profit, I may also want to know what level of sales do I need to make $1 million. Well, all I have to do then is add the target net income to the fixed costs. So I have required sales, 500 per unit, variable cost, 300 per unit, total fixed cost, and target net income. They want 120,000 in profit. And I divide through, I get 1,600 units. On a contribution basis, the same thing. I know my contribution margin is 200. How many units do I have to sell to cover my fixed costs and give me a profit of 120? I simply add 120 to the 200, divide by 200, and I get 1,600 units. Now, if I was to use the ratio, then I just take the target or the break even, I need the fixed cost plus the target net income, divide through by the contribution margin ratio, and my break even is $800,000. So you see, if I use contribution margin per unit, my answer is in units. If I use contribution margin ratio, my answer is in dollars. The last concept, margin of safety. Not only a company will know what its break even is and will know what it's actually selling or expects to sell, And that margin of safety is the difference between what they're selling and what they need to break even. That is, hopefully they're selling more than they need to break even. Therefore, they have a cushion. And the size of, oh my goodness, that's the end of that. Okay, game over.